So China just released a new artificial intelligence, and it just had a huge effect on the US stock market and even crypto.
The release of DeepSeek AI from a Chinese company should be a wake-up call for our industries that we need to be laser-focused on competing to win.
China's latest AI breakthrough has leapfrogged the world.
I think we should take the development out of China very, very seriously.
A game-changing move that does not come from OpenAI, Google, or Meta.
There is a new model that has all of the valley buzzing.
But from a Chinese lab called DeepSeek.
It's opened a lot of eyes of like what is actually happening in AI in China.
What took Google and OpenAI years and hundreds of millions of dollars to build, DeepSeek says took it just 2 months and less than $6 million.
Now, this is not just another tech gadget or a new meme coin, it's something so much more powerful. Mark Andreessen, who's one of the most respected names in venture capital, said it's one of the most amazing things he's ever seen, and it's now available for everyone to use. So what is it and what can it do?
A newly unveiled, free, open source AI model that beats some of the most powerful ones on the market. But it wasn't a new launch from OpenAI or model announcement from Anthropic. This one was built in the East by a Chinese research lab called DeepSeek.
And it turns out its capabilities are pretty mind-blowing. Imagine an AI that can build entire video games from scratch, even if it has to use programming language it wasn't originally trained on. It can do that. Imagine an AI that can extract just the reasoning from complex data sets to solve problems with super sharp precision. It can do that. Imagine an AI that thinks in real time, adapting to new information as it comes in while telling you its logic. It can do that. An AI that can also scrape data from YouTube channels to analyze trends and potentially predict what's going to go viral next. And it can do that too. That's DeepSeek AI. But that's not even the crazy part. The crazy part is that US tech companies like OpenAI spend over $5 billion a year and many more billions of dollars to develop this technology, and this model from China cost $5.6 million to create. Not billions, a few million. And DeepSeek R1, which is one of its open source language learning models, is 10 times cheaper than OpenAI while having an almost identical performance and in some cases better than GPT-4.
It beat Meta's Llama, OpenAI's GPT-4o, and Anthropic's Claude Sonnet 3.5 on accuracy on wide-ranging tests, a subset of 500 math problems, an AI math evaluation, coding competitions, and a test of spotting and fixing bugs in code.
And they gave it away for free. Unlike OpenAI, which is ironically closed source and the code is private, DeepSeek is completely open source and the code is available to the public, which means China was able to recreate and catch up with our AI technology on a very limited budget with very limited access to the hardware that would make this possible. And because of this economic limitation, they figured out workarounds and pretty much ended OpenAI's dominance.
Today, we released Humanity's Last Exam, which is a new evaluation or benchmark of AI models that we produced by getting, math, physics, biology, chemistry professors to provide the hardest questions they could possibly imagine. DeepSeek, which is the leading Chinese AI lab, their model is actually the top performing or roughly on par with the best American models.
And that leaves me with a couple of interesting questions like, how does this affect the United States if the US was thought to be years ahead of China in this field? How will this affect the stock market, specifically tech stocks, because they've gone up specifically because of this story of US superiority that's no longer true? And where did this AI really come from? And how does it actually work? And how can it make me rich? So with that said, let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the AI. So let's start from the beginning. Where did this technology come from?
Despite its breakthrough, very, very little is known about its lab and its founder, Liang Wenfeng. According to Chinese media reports, DeepSeek was born out of a Chinese hedge fund called High Flyer Quant that manages about $8 billion in assets.
But unlike OpenAI or Anthropic, which have super detailed charters and principles, DeepSeek operates with a level of secrecy because We don't know much about its founder or how they were able to put together the team or the hardware to build this technology because of the sanctions placed on China by the US. But what we do know is that they did it in just 2 months and at a fraction of the cost that US companies spent.
How did they actually assemble this talent? How did they assemble all the hardware? How did they assemble the data to do all this? We don't know. And it's never been publicized, and hopefully we can learn that.
So the next question is, how is it any different than OpenAI, and why is it better? And one of DeepSeek's most impressive features is called chain of thought reasoning. This means the model doesn't just spit out answers at you, it shows you its thinking process. For example, if you ask it to solve a math problem, it will first break down the problem into smaller steps, explain why it's doing what it's doing, and then it'll give you the final answer. And this makes it not only more transparent, but also more reliable for things that need detailed planning and logical thinking. And why this matters is because chain of thought models like DeepSeek R1 are much better at handling complex, multi-step problems than traditional language learning models. So whether you're solving a tricky math equation or debugging a code or planning a project, DeepSeek's ability to reason while showing you its reason step by step gives it a huge advantage over OpenAI's GPT-4. So the next question is then, what's their secret and how were they able to do this? And the secret is efficiency. Even though the US placed semiconductor restrictions that cut off China from accessing NVIDIA's most powerful chips, DeepSeek found a way to create this technology with a lot less resources than the US. They used NVIDIA's H800 GPUs, which are less powerful than the H100s, but they optimized their training process to squeeze every ounce of power out of them.
But China has caught up in the last 6 months in a way that is remarkable. The fact of the matter is that a couple of the Chinese programs, one, for example, is called DeepSeek, looks like they've caught up.
And they also use super clever techniques like mixture of experts architecture and 8-bit float point training, which lowered their computational costs while maintaining stability. And the result is a model that's not only cheaper, but also faster and more accurate in a lot of benchmarks.
They can take a really good big model and use a process called distillation. And what distillation is basically you use a very large model to help your small model get smart at the thing that you want it to get smart at.
Now, it's not better in every test they did, but it's better in a lot of them. And now the big philosophical question is, which one is better, open source or closed source?
I don't trust OpenAI. I don't trust Sam Altman, and I don't think we want to have the most powerful AI in the world controlled by someone who is not trustworthy.
Now, the United States and its companies decided to go closed source. In other words, the knowledge code is not available to the public, which is a big criticism that Elon Musk had against OpenAI. DeepSeek and China decided to go the other way, the open source way, meaning the code is public for everyone to copy and use without paying a huge amount of money. And the cost difference is really big. For example, OpenAI charges $4.40 per million tokens. DeepSeek's API costs just 10 cents per million tokens. And by the way, think of tokens as the building blocks of language. Every word and punctuation mark counts as a token. So if I asked an AI bot, "How are you?" that would be 4 tokens. How are you plus the question mark. Now, why this matters is because if you're trying to build a company that uses, let's say, an AI chatbot for customer service because you can't afford to hire real people and a team of customer service reps, if you have 10 million tokens per month in inputs and outputs, you'd be paying $44 a month with OpenAI versus just $1 a month with DeepSeek. That's a 97% reduction in cost. And that means American developers are already building on DeepSeek's platform instead of OpenAI's. So ultimately the question is, why should we care? And we should care because it's not just a story about technology. It's a story about power between 2 countries. Remember all those videos talking about inflation and people asking, what does the US really export? Inflation and the US dollar. But really, what the US exports is technology. Because for decades, the United States has been the undisputed leader in technology, AI innovation, thanks to companies like Apple and Google, Microsoft, Amazon, and now OpenAI. And DeepSeek could change all of that.
Those chip restrictions from the US government, they were intended to slow down the race, to keep American tech on American ground, to stay ahead in the race.
What we want to do is we want to keep it in this country. China is a competitor and others are competitors.
So instead, the restrictions might have been just what China needed.
If China is successful in deploying this technology at scale, it could give them a significant edge in everything from economic growth to even military dominance. And this technology could, in theory, be used to optimize their economy, predict global market trends, and maybe outmaneuver their competitors on the world stage. And it's not really hard to see how this could shift the balance of power. And if investors start to doubt US dominance in AI, we could see an even bigger sell-off in tech than we already have. Companies like NVIDIA, which supply the chips for AI, could be hit especially hard. And for the average American, that could mean a hit to their 401k or retirement savings. We're looking at over $620 billion in market losses in just one day from one news story. There's never been a bigger single-day drop for a US stock ever. But this didn't stop at NVIDIA. Look at all the red in tech. At a time when these tech companies represent a record amount of space in the S&P. And if the infamous NVIDIA bull Nancy Pelosi didn't see this coming, then it shows you how important it is to diversify early. Now, I've talked about diversifying into alternative assets like crypto for years, but unlike crypto, one alternative asset class has actually had a negative correlation to stocks over the last 30 years. And I'm talking about blue chip contemporary art, which sounds crazy to even consider for investment until you learn about all the billionaires who sit on 9-figure plus art collections, including the people behind this new tech revolution like VC Mark Andreessen from earlier, or Microsoft co-founder Paul Allen, who had a $1 billion auction. Jeff Bezos even spent $180 million last year on a single painting. But it's not just them. In 2023, Deloitte estimated the overall wealth held in art and collectibles was nearly $2.2 trillion and projected to hit almost $2.9 trillion by 2026. But the second reason why you might want to care about this is because of money and the stock market. What does this all mean for the valuation of some of these AI stocks now that this has happened? Because for the last few years, the stock market, which is mostly driven by tech stocks, has gone up thanks to this story that AI is going to revolutionize the world. And the US is going to see most of that benefit since it's the one that's pioneering this space. I mean, think of how much money was spent and invested by venture capital to make ChatGPT, and then Tony Stark all of a sudden shows up and builds the same technology in a cave in just a couple weeks.
Tony Stark was able to build this in a cave with a box of scraps!
Imagine all the people that spent billions of dollars investing only to realize maybe it should only cost a couple $1 million and not take years and years to make.
As Chamath Palihapitiya puts it, let me say the quiet part out loud. AI model building is a money trap.
That's one of the wake-up calls we just had this week when the stock market corrected. But I do think there is a lesson in all of this. And the lesson is that it's now more important than ever for countries to work together to develop this technology instead of thinking about this as an arms race. But that's probably easier said than done for an entertainer on social media than it is for the leader of a country. But here's where I think we're about to go next in the world of investing. The next story of what's about to drive the market and all the hype and all the money that's going to go into it is less software AI driven and more hardware AI driven. And that's because there's only so much we can train data systems on just by feeding them textual data and information. So the next phase will be feeding these systems with practical physical data. And I'm talking about robots. Actual robots doing things and learning how to build and create, which will be the next leg of this race. But I'd love to hear your thoughts. Thank you so much for watching. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
What's up, you Graham? It's here, guys, and I hope you're prepared for what's about to happen in 2025. Despite the market rallying on a Trump election, tariff delays, and a variety of executive orders soon going into effect, as of a few hours ago, the Federal Reserve once again decided to pause any interest rate cuts for the foreseeable future, except this time, there's no going back. For instance, Jerome Powell has just signaled that they intend to keep interest rates higher for longer, putting him on a potential collision course with Trump. Experts are now warning that the AI bubble could soon be over, and lately there are more and more warnings about the mother of all bubbles popping, with market euphoria and speculation going absolutely wild. So with some rather significant changes soon going into effect, we gotta discuss exactly what's happening, how a Trump economy is going to affect 2025, the impact this is likely to have on everything from stocks to real estate to cryptocurrency, and then most importantly, how you could use this information to either make or save yourselves as much money as possible. Although really quick, before we start, if you appreciate the last minute updates like this, it would mean the world to me if you just hit the like button or subscribed. It's totally free, it takes you a split second, and as a thank you for doing that, I'll do my best to respond to as many comments as I can. So thanks so much, and also a big thank you to Surfshark VPN for sponsoring this video, but more on that later. Alright, so in terms of why the Federal Reserve is choosing to pause rates throughout the beginning of 2025, we need to talk about the one term that sends chills down every investor's spine, the boogeyman of inflation. Okay, I know that sounds a bit confusing, but all you need to know is this. We have two different kinds of inflation. One measures the price of everything, known as CPI, and the other excludes more volatile categories like food and energy, because those could rise and fall depending on the season. And in terms of everything, prices did end up actually going a little higher. In this case, prices moved from a 2.7% increase in November to a 2.9% increase in December, driven higher by rising grocery costs, or mainly eggs, which have seen a 37% increase since 2023. Gasoline prices are also up 4.4% from a month ago, and housing is up 4.6% from this time last year, which brought up the average and gives us this 2.9% headline increase that we see here. However, if we just ignore the cost of groceries and eggs and gasoline, our core inflation actually decreased from 3.3% in November to 3.2% in December, giving some hope that inflation is beginning to make some progress, but honestly, the good news somewhat ends there. Even though prices are starting to come down from their peak in 2022, the average worker's earnings are still not keeping up with the pace of inflation, rising just 1% from the year prior. This means if you now make 1% more than you did before, but prices are 3% higher than they were before, congratulations, you are now effectively taking home 2% less. However, now that Trump is back in office, there are some major changes that could soon go into effect that could theoretically save you a lot of money, and that's what brings us to the Trump tax cuts. Now, in terms of these proposed changes, number one, all the 2017 tax cuts will be made permanent. This means the top tax bracket is going to remain at 37% instead of the previous 39.6%. Those amounts would more or less be adjusted to inflation every year, and we're probably going to get more of the same to what we're already accustomed to. Second, Trump is aiming to lower the corporate income tax rate from 20% where it is now down to 15%. This one is admittedly fairly significant because it would be substantially lower than where it was back in 2016, which was at 35%. Third, there are proposed tariffs on imports. The thinking here is that this would encourage more production within the United States. The revenue generated from this would more than offset the tax cuts to American citizens, and our economy would thrive. But critics to this say that this would just end up with higher prices for American people. Other countries could retaliate with their own tariffs. American companies would bear the brunt of these import fees, and this would likely just offset all the money being saved elsewhere. But we'll see. Fourth, overtime pay and tips would be exempt from federal tax. To me, I think this is a huge opportunity for workers to increase their take-home pay, but I also can't help but feel like this could also be perfect for certain people and employers to abuse. So we're probably going to have to wait and see for specific instructions on how this will work. Otherwise, it could be an all-out cash grab. Fifth, he could propose to end tax on all Social Security income. Now, I think this one could be pretty substantial for current retirees, but critics of this warned that it puts a strain on a very delicate tax system to begin with. It drains the Social Security fund more than where it's currently at, and it predominantly benefits people who already have a high income to begin with. Although I also think that could lead to a lot more discretionary income within our economy, which is a good thing. So again, we're gonna have to wait and see what happens here. After that, 6, estate tax cuts would be made permanent, which means a married couple would have up to $28 million of exclusion on inheritances. But since this probably only impacts like 1 or 2 people watching this video, we'll move on to the next one, which would be number 7, raising or ending the SALT cap deduction. For those unaware, this capped the state and local tax deduction at $10,000 against your federal income taxes. So if you pay any more than that in state taxes or property taxes, you're probably missing out on some pretty substantial savings and write-offs. And finally, 8th, clean energy tax cuts would be eliminated and no longer providing a financial bonus for buying EVs or Teslas. Now, even though this list is quite comprehensive, realistically, not all of it's going to pass, and even more realistically, we're probably just going to see a watered-down version of all of this by the time it goes into effect. Anyway, in terms of what this means for the stock market and housing prices in 2025, you're going to want to listen to this, because here's where things get crazy. All right, now before we talk about Jerome Powell's latest statements and plans for 2025, we need to talk about what's happening with the stock market. First of all, it's no surprise that 2024 was an absolutely phenomenal, somewhat record-breaking year for stocks, with the S&P 500 rising by more than 23% after 2023's returns coming in at a whopping 26%. But in terms of this year, the results, according to analysts, are somewhat mixed. See, as of lately, only 28% of stocks within the S&P 500 are beating the index, meaning the vast majority of profits are simply coming from the largest 7 companies that are doing incredibly well, and that would be Google, Apple, Amazon, Meta, Microsoft, Nvidia, and Tesla. And this type of concentration really hasn't been seen before since 1998 and 1999, right before the dot-com bubble. On top of that, many investors are beginning to worry that the artificial intelligence momentum is officially over now that DeepSeek is theoretically able to operate on a fraction of what we've been using here in the United States, causing the entire market to begin selling off in a panic. Now, if you believe DeepSeek in China, then yeah, perhaps the market is a bit overinflated and needs to adjust. But if you don't believe them, then time will tell. Anyway, in terms of whether or not we're going to see a significant market correction this year, the answer is, as of now, probably not, at least according to the experts. For example, Goldman Sachs projects the S&P 500 to end this year at 6,500, which would be a 10% increase at today's levels, including dividends. Other firms also agree with this, including Morgan Stanley and JP Morgan Chase, and Oppenheimer came in with the most bullish case, believing the market could rise another 20% by the end of December. In terms of why, it's said that proposals to lower corporate taxes and ease regulation are seen by many investors as easy to put in place and broadly positive for company profits in the stock market. On top of that, it's said that some analysts see U.S. stocks' impressive growth as evidence of a new era in tech and AI, with sustainable valuations and strong future earnings growth to support a continued rally. Of course, there is the worry that tariffs could put a damper on the economy and cause prices to rise, but others say that I don't think tariffs will be as severe. The bark will be worse than the bite. Although keep in mind, when it came to stocks in 2024, every single analyst's prediction was wrong, and even the most bullish cases didn't even predict half of what we wound up seeing. In fact, over the past 25 years, 53% of almost 400 firm forecasts surveyed by Bloomberg clustered between 0 and 10%. So basically, everyone is playing it very safe, guessing very average returns, and then hoping they're not wrong by the time the actual numbers come out. Thankfully though, despite the experts having absolutely no idea what's going to happen, historically, when the S&P 500 climbs 2 years straight, it rises the next year 71% of the time. The average third-year return is 9.4%, and when the S&P 500 rallies 20% or more 2 years in a row, as it did in 2023 and 24, the index goes up the following year 67% of the time, and the average third-year return is 7%. So overall, according to the past data, things do look pretty good, but it's worth being reminded that it can be a good idea sometimes to also play it safe, and that anything can happen when you least expect it, especially when it comes to something like the housing market. Look, it's no surprise, despite national mortgage rates remaining above 7%, housing prices in 2024 have defied the odds, having increased by an average of 3.4%. But in terms of what's happening in 2025, you better get ready. The top 10 metros saw average gains of 1.9 to 5.8%, with the highest returns coming from Miami and Chicago. Meanwhile, the worst markets saw average declines of 3.5 to 2%, including Wyoming, Idaho, Washington, and Hawaii. And in terms of where they think the market's going to go throughout the rest of the year, their answer is really more of the same, with another 3.8% increase over the next 12 months. Although Zillow has a few extra details about 2025 that are are absolutely worth mentioning. They think the housing market's going to see an average increase of 2.6% this year, which is basically the rate of inflation, and that buyers will begin to have the upper hand as more inventory gets listed on the market. They also believe that mortgage rates will remain volatile, but on the high side, and that more buyers are going to relocate to the Southwest, where affordability is, I guess, more affordable. Anyway, with prices and mortgage rates as high as they are, smaller homes might start to see more demand as they become cheaper when you compare them to larger homes, and rents may finally begin to creep back up as the multifamily construction boom is pretty much over. However, over the next 5 years, most experts seem to think that we're probably just going to get more of the same with elevated mortgage rates and high prices, unless of course we see a massive recession which forces the Federal Reserve to lower rates back down to where they were in 2020. After all, single-family home construction never really recovered after the 2007 Great Financial Crisis, so there's probably going to be a shortage of inventory for quite some time, and we may never get back to the levels that we saw about 20 years ago, which, by the way, it's kind of crazy that 2005 is now 20 years ago. What happened? Where did the time go? Tell me. That is so trippy. I'm getting old. Okay, back on topic. From now until 2030, it's predicted that housing prices are simply going to rise just beyond the rate of inflation as they have been over the last century. And that also means that the more money gets printed into our economy, the higher the price that most assets are going to be rising. All of that is to say that, unfortunately, we're probably not going to see housing affordability improve over the next few years, and that even though more inventory may come on the market, it's probably not going to be enough to put a dent in prices. Although in terms of what Jerome Powell has to say about all of this and his plan for 2025, here is what you came for. As of a few hours ago, Jerome Powell signaled that they intend to pause any interest rate cuts for the beginning of 2025. And the most likely scenario so far is that we just get 2 25 basis point rate cuts by the end of the year, and that's it. After all, the way they see it, we are still above their 2% inflation target. Asset prices have not fallen whatsoever, and the unemployment rate is still fairly low, all things considered. So for them, there's very little risk in keeping interest rates somewhat elevated where they are right now, and then lowering them if needed in the event our economy needs a bit of a boost. Not to mention, they've also removed language this morning about making progress on inflation, which isn't exactly great for the markets, because if inflation remains elevated, you know what else remains elevated? Interest rates. Now, some people think that Trump might try to pressure Jerome Powell into lowering interest rates prematurely as a way to boost up asset prices, and that's something certainly worth considering, especially because this happened back in 2018 once the market began to fall. But up until now, there's really no indication that this is going to be the case, and it's really up to us just to wait and see what ends up happening. Besides that, though, Jerome Powell really just gave us more of the same today, implying that they're going to be very cautious, only lower interest rates if absolutely needed, and respond to the labor market in the event we start to see unemployment spike higher. This is why if everything stays the status quo, most likely we're just going to get 1 or 2 small rate cuts in 2025, and that's it, pending a absurd black swan event that nobody sees coming, which is a possibility. You never know. But as of now, it's looking like rates are going to be staying a bit higher than most people wanted them to. No, this isn't exactly bullish for the stock market, but it does give the Federal Reserve a lot of optionality to lower rates if they absolutely have to. Now, as far as my own thoughts about everything that's just happened, it seems like earnings growth is strong for stocks. Most of our economy has adjusted to higher interest rates without completely destroying our portfolios, and the biggest risk is simply what happens if everything goes wrong. Like, to me, the biggest what if just has to do with tariffs. I mean, there is a situation in which Trump negotiates too hard, other countries retaliate, we find ourselves in a trade war, prices spike to unsustainable levels, and the stock market begins to sell off. It's not impossible, and there could be some rather serious consequences if things go wrong. But there is also a chance that he doesn't put as much pressure as we expect. The United States saves a lot of money and flourishes, and everything turns out great. We just have no idea. Or DeepSeek completely collapses the artificial intelligence premium pricing in the market, causing stocks to begin selling off into the abyss. But then again, what do I know? This is why I'm playing it optimistically cautious. Like, I'm still keeping an emergency fund on the sidelines just in case, but I'm still buying in on a regular basis and continuing to invest, and that way I don't miss out on any of the upside. As an example of this, just take the research from the Wealth of Common Sense blog. They found that historically, over a 20-year term, everything so far has been profitable, and over a 30-year term, the market has not returned less than 8% a year. On top of that, they've also found that since the 1950s, we have spent less and less time in a recession or a bear market. So that's just a little piece of information to keep at the back of your mind. Essentially, everything that's happening today is somewhat of uncharted territory, and that's why it's always a good idea to save as much money as you can, continue investing as normal through the ups and the downs, and no matter what, hit the like button and subscribe if you have not done that already. So with that said, thank you so much for watching. It really means a lot, and until next time.
Hey everybody, welcome back to Whiteboard Finance. In today's video, we're going to be talking about how DeepSeek is hammering U.S. stocks. So is this a big Chinese psyop? Is this market news real? Well, we're going to dive into it right now. So DeepSeek is hammering U.S. stocks. So what is DeepSeek? So this is a Chinese AI startup founded in 2023 by Liang Wenfeng. It develops open source AI models, and this app articulates its reasoning before delivering a response. So that's kind of its big differentiator between OpenAI and Meta and Gemini. And it does this for a fraction of the cost, and we'll get into this later in the video. It's kind of the whole point of the video. So DeepSeek has officially become the #1 app in the App Store in both the US and China. So less than a month ago, this app did not even make the top 100 list. So search interest in DeepSeek is now nearly triple the levels seen in ChatGPT and Gemini. So how does this actually compare to OpenAI or Meta? So I know that this font is kind of small, and I'll show you what these red boxes are pointing to or highlighting. But basically, the cost of training and developing DeepSeek's models are a fraction of the cost. They're more efficient. This is all reported. Whether it's true or not, we'll have to figure that out. But this basically affects AI accelerators, companies such as NVIDIA, AMD. There's a bunch on the list that we'll go over here. And basically, the United States, they banned advanced semiconductors to China because they actually don't want this happening, right? It's that big AI/crypto/space race. This could potentially be a Sputnik moment many years later. So this ranks among the top performers on Chatbot Arena. So I know this font is kind of small. I try to cram in these two screenshots that I took. But basically, DeepSeek is coming in 4th right here. And then also, if you look at the overall score, it's very close to ChatGPT and Gemini. And then also, if you look at this chart right here, DeepSeek is now a top performer in AIME, Math 500, and GPQA benchmarks compared to ChatGPT. So DeepSeek is this dark blue line, or bar, excuse me, and then OpenAI is this dark gray one. So you can see it's very close in all these other categories and actually beats it in these 3 down here. So if we move forward, this is DeepSeek R10 AIME accuracy during training. You can see here that at about 8,500 steps, it actually starts to surpass competition, making it more accurate. So why is this such a big deal, though? So the whole point of this video is that DeepSeek was developed for a fraction of the cost of ChatGPT. Okay, so to train the model, it cost about $5.8 million. This is according to DeepSeek, so obviously this could be true or not. But there's debate about the total cost to develop it online, which is what I'm seeing on X or Twitter, whatever you want to call it. But let's just assume it costs $2 billion to develop, or 350x their stated cost. Okay, let's just pretend. DeepSeek was developed at a fraction of the cost. So you have OpenAI raising $6.6 billion in their last round of funding alone. Okay, so you can see in the picture off to the right. This is a screenshot from October 2nd, 2024. We've raised $6.6 billion in new funding at a $157 billion post-money valuation to accelerate progress on our mission. So OpenAI has 4,500 employees. Okay, DeepSeek has about 200. Okay, this is a 22x. So the whole point of this slide is to show you that they're doing this not only. Well, some people are saying they have 50,000 NVIDIA chips, but some people are saying they have less advanced chips. So the moral of this slide is basically saying they're doing just as much, if not more, with a lot less. Okay, so what's the big deal continued? So DeepSeek is 90% cheaper than ChatGPT. So the cost of OpenAI 01 is $60 per 1 million output tokens. The cost of DeepSeek R1 is $2.19 per million output tokens. So DeepSeek R1 is 100% open source, and it's a fraction of the cost of ChatGPT. So it's cheaper and better according to these numbers. So this is pretty important because semiconductors have become huge. This is actually bigger than the dot-com bubble by 1.2%, and it actually holds a record 5% of the U.S. market. So if we go back to the dot-com bubble, it was basically underneath 4% or just under 4%. If we go to now, you can see that it's above 5% right here. This is the market cap weighting. This is just because of the explosion in semiconductor stocks, as we've been seeing over the past couple of years. So this news is also important because, I don't know if you guys have been following this, but President Trump announced $500 billion Stargate project to develop AI. And also, Meta is actually investing $60 billion in a data center the size of Manhattan. So DeepSeek has investors questioning the development costs on anything related to AI last night and this morning at the time of this recording. And if you want to read all this, you can just pause the screen. But I want to get into this part. Usually I would give you kind of like the my thoughts section of the video, but I'll be completely honest with you. I'm not an AI person. I have been following NVIDIA and AMD for many, many years. I remember when AMD was like $8 a share. Okay, that shows you how old I am. Now it's at about, I think, 115 at the time of this recording. But let's take a look at what some analysts are saying. So you basically have the DeepSeek sell-off. JP Morgan is suggesting that the AI investment cycle might be overhyped. DeepSeek's efficiency could lead to a more efficient future. This guy from Jefferies is saying that two strategies post DeepSeek: continue investing in computing power or focus on efficiency, potentially reducing 2026 AI capital expenditures. Then you have contrasting views. You have efficiency and costs. You have market dynamics. I'm not going to read every single one of these. You can just pause the screen and read it. But then also I wanted to read this one tweet of a contrarian viewpoint. So this gentleman on X, he goes, DeepSeek, I'm not buying it. Yes, they have a great model, but the cost just doesn't add up. You can't even buy a beachfront home in California for $6 million, but the trustworthy CCP built a better language learning model than Meta for that price. China has a long history of lying about technological advancements, so it wouldn't surprise me if this was the latest example of CCP trying to act like they're ahead of the world. Am I denying that it can be done for cheaper than what I'm seeing right now? No, it probably can, but this is not new information. Zuckerberg and Sundar both admitted to overspending on AI, and then he keeps going into the, this bear case or why China may be lying. So my thoughts, I don't have any thoughts. I just know that there is a big sell-off this morning. The reason for making this video is to make you aware of this. This reminds me, I'm not old enough to remember the dot-com bubble. I'm 37. That was when I was a little kid. I was riding bikes and selling Pokemon cards. But I do remember 07, 08, and I do remember a lot of different booms and busts. I'm not going to compare this to like SPACs or Nikola or fake technology of 2020, 2021. But there is, I don't want to say a bubble because this could be world changing, but I don't have enough knowledge to be a subject matter expert on AI. I'm just bringing awareness to you because I do think that the market in general is just overheated and a lot of stuff is very expensive. If you look at the S&P 500, it's basically just being propped up by the Magnificent Seven for a couple years now. So just be cognizant of that. I don't own any of these stocks individually, but I do have a majority of my net worth in something like a total stock market fund. So anything that can deflate these top 7 stocks is going to affect you in one way or another. So take a look at this, do a little bit deeper research, but I just try to highlight as many important points as I could in this short video. Thank you so much for watching and have a prosperous day. Hey, my love. Did you sign up the girls for their Mandarin classes yet? Okay, perfect. Shay Shay.
First, we're taking a look at Apple as the tech giant's first quarter results just now hitting the wires. And let's get you those numbers. EPS first quarter, $2.40. That's versus expectations of $2.35. Revenue, $124.3 billion versus expectations of $124.1 billion. So beats there on the bottom and the top for Apple. Revenue did jump about 4%. Gross margins do hang in there, 46.9%. The street was closer to 46.56. If you go through the segments here, Julie, iPhone clocks in 69.14 billion. Now the street was closer to 71.04 billion. Services 26.34 billion. That's versus expectations of 26.1 billion. iPad is a beat at 8.09 billion. Mac is a beat at 8.99 billion. Wearables, home and accessories, that is a bit light, 11.75. The street was closer to 11.95 billion. Finally, Greater China clocks in at 18.51 billion. I did have the chance to speak with CFO Kevin Parrick about these numbers. He did point out to me the install base of active devices has reached a new all-time high across all products and geographic segments. About the iPhone number, I did ask him, obviously, did he come in lighter than what the street was looking for? Were there puts and takes that maybe the street and analysts had missed there? He pointed out, listen, iPhone results roughly flat. We saw where we rolled out Apple Intelligence, he told me, it was better than where they had not yet rolled Apple Intelligence, and said that iPhone 16 overall, since the launch, doing better than iPhone 15 did. He called these positive stats. Because of that, I asked him, given the difference in rollout there with Apple Intelligence, any update he could provide right now in terms of when European or Chinese regulators would approve Apple Intelligence. He said there was no update to give on that front as of yet. I asked him another question. This is one that had come up in conversation I had with analysts who kind of raised this question, are we still very early in consumer AI generally? Is it still too early, they asked, to create a really truly powerful and sustainable iPhone upgrade cycle? He said, listen, we are just starting to roll out Apple Intelligence, basically saying it's still early days. The feature set's expanding. First chapter is kind of how he summarized it. On DeepSeek, obviously that came up in conversation. Claims, again, it created a model at much lower cost than American rivals. As the cost of AI did come down, could that mean app makers, I asked him, software companies, could create that many more AI experiences? That's one theory out there, that long-term that would be a tailwind for Apple in the upgrade cycle. In general, he just said, listen, we look at innovation to drive efficiency. China, I do want to get to that and what they're seeing in the business there. And I asked him whether there are any shifts over there in terms of the macro, in terms of the competitive landscape. He said, listen, as for the results, if you look at the decline, he said some of that is a reduction in channel inventory. He said Apple Intelligence, he stressed again, has not been made available in that market yet. He also noted how national subsidies have just started rolling out there in January. So bottom line, we see beats on the bottom and the top. Looking at the initial reaction of shares here, we're flat. Remember, we don't have guidance yet, Julie. Very importantly, that's going to come on the call at 5 p.m. Eastern. You wouldn't expect formal guidance, but more color and commentary.
Yeah, I mean, the stock's been bouncing between gains and losses ever since these numbers came out, in a pretty tight range here as investors are perhaps waiting for more. But I think the confirmation of all of the chatter that's been coming out in recent weeks, that Greater China sales fell by 11%, that is something that is going to be a worry to investors. Even if, the company says, yes, we're going to roll out Apple Intelligence there and things are going to improve, I think really that remains to be seen, and investors are going to want the proof that that is happening, not just the promises that is happening, whether it's the company itself saying it or some of these research firms that get a handle on that once they start rolling it out. So that's something to keep an eye on. I also think we have to put the stock move in perspective here. The stock was up 30% last year, remember. It actually hit a record high the day after Christmas, December 26th. And since then, it's down about 8% or so. So it's still trading relatively close to a record high. When coming into this report, it had dipped and then climbed a little bit. So people were maybe looking for a not worst case scenario for these numbers. And the numbers are good.
Thank you.